Welcome to the very first episode of AlphaCast, a show dedicated to interviewing traders and investors who've managed to create alpha. In this very first episode, I have the absolute pleasure of interviewing Marsten Parker. For those of you that don't know, Marsten Parker is the world's only systematic market wizard who's trounced 99% of New York hedge fund managers for over 2 decades. In this interview, we start by understanding how he got into investing, his journey to become a systematic trader, and what he's up to today. And during the interview, he shares some insights that you're probably going to be hard-pressed to find elsewhere. So without further ado, Marsten Parker. Marsten, pleasure to have you speak with me today. The first thing that I'm really interested in is just kind of understanding your story. Can you give us a little bit of a background about how you got into trading and that path?
Sure. It's a pleasure to be here. Thanks for inviting me on your new podcast. And of
course.
So my story in a nutshell, going back to high school, my 2 main interests were classical violin, classical music, and computer programming. I actually pursued the former by going to a conservatory in New York City, which was an efficient way to learn that I wasn't going to be one of the top violinists. and that was in the early 80s when personal computers were first coming on the scene, and that was an exciting time, and I just got more and more into that. Moved back to Boston, where I grew up, and managed to get myself a computer and learned to program, and but very luckily, without having any formal education in it, got offered a job as a software engineer, and moved from one company to the other. Long story short, the last company I worked at actually went public in 1996, and I owned about 4% of it. And in those days, companies went public when they were tiny, so 4%, was only like $1 million or $2 million. But so I had a good exit, and then I had an investment problem of what to do with that money, and I didn't want to just give it to a financial planner and pay their fee and everything, and so I started buying books about trading and investing. I started out thinking investing, but kind of gravitated more towards shorter term trading.
Sure.
Just dabbled in this and that, with discretionary stuff for about a year and lost some money, and then met somebody who was writing about a systematic approach on a website called thestreet.com back then, and ended up getting to know him and working with him for a while, and went from there.
Okay. Now, did you ever give your money to a financial advisor by any chance?
No, I had a meeting with one, and said, "No, I don't think I'll take this path." I guess
you're smarter than I am.
To do it myself.
Yeah, what's funny is because I ended up, I kind of came from a trading background from a completely different perspective. I started with valuation and whatnot, but that's how I got into investing initially, and then trading was, I purchased some shares, and then the stock went up, and then I looked at my account balances, and I still somehow lost money. And then that was a clear message when I looked at the fees. I'm like, I'm going to have to start figuring out how to do this stuff myself.
Yeah.
Obviously, I know a lot about your background. I've read the Market Wizards books and things like that. And I guess, the first question that comes to mind is, back in those early days, whenever you were constructing these trading systems, I guess you first started learning technical analysis with, I guess it was your one partner initially, and then you started back testing. Can you give us some ideas of maybe some of those strategies that you were using back then to kind of give the audience who, a lot of the watchers on this channel are interested in trading and basic systems, to kind of give them an understanding of maybe what those systems look like?
Sure. When I first started, I didn't have any techniques, and I didn't even know what techniques I was supposed to be looking for.
Right.
As I recall, but I kind of knew from the beginning, just because of my personality, I wanted something systematic. In other words, I wanted a set of rules to follow. I didn't want to just try to do it purely by intuition. I think the very first rule I came up with in a book was take like the stocks in a major index and rank them by PE over growth. and choose the ones with the highest PE divided by growth rate. Or no, the lowest PE divided by growth rate. Yeah, it was sort of like, growth at the right price. I think that was even used as an acronym back then. And I remember putting on a couple of positions like that and holding them for a week or two and seeing they didn't go anywhere. And then I got bored and decided to try something else. So I had no real conviction, but I was reading wherever I could online and in books. And this guy, Gary B. Smith, was writing a column called Technician's Take in thestreet.com.
Okay. And roughly what year was this?
1997.
Okay.
He, I think you can still find his articles on there. One or two of them even mentioned me, but he was unusual among things you could find online in that he just disclosed the exact rules of the strategy he was trading, and it was kind of it was rule based with some discretion on the entry side and completely mechanical on the exit side. It was a derivation of the William O'Neill strategy and how to make money in stocks. They're so-called CAN-SLIM, but subtracting out all the fundamental parts and using a smaller profit target. The daily process of that system was run some kind of a scan for stocks that had unusual volume breakouts the prior day. I mean, initially our scan was to literally look in the printed edition of Investor's Business Daily because they had a table of them, and then type those symbols into a charting program and see if it looked like nice tight consolidation prior to a breakout. And then simply buy a fixed number of shares at market at the open the next day and tell the broker to put a bracket of I think we used a 5% target and a 7% stop or something like that. And then you just don't do anything till one of those is hit. And so I started trading that strategy with him in early 1998. And there was also a short version as well. So we were always trading long side and the short side. And then in hindsight, that's probably the most important thing I got out of that was to always trade both sides. It was my first foray into strategy diversification. And we had a good year. It was something like plus 50% in 1998. And 98 was not like 99. It had big moves in both directions. But we were able to catch pieces of the moves in both directions because we were long and short. And so that was the semi-mechanical, semi-discretionary approach that year. And then during that year, I was starting to build the backtesting just because I would look at the trades we were doing and I would be curious, well, what if we had used these exit rules instead of those? And then, so first I built something to test the exit rules, and then I started wanting to test the entry rules, and then I started wanting to test different entry rules. So it just kind of evolved bottom up like that from what we were actually doing.
And is that, I know that you have RealTest, is that the initial
that
version
was
of that?
The origin of RealTest. Okay. Yeah, I think my first version of it was scan test, because our process was, eventually we realized we could get data over the telephone through a modem and run scans instead of having to look in the newspaper. And then I started wanting to test those scans. So the first version was scan test.
For those of you that don't know, RealTest is Marsten's backtesting engine that, from a unique perspective, it can test multiple strategies at once, which, helps significantly with the equity curve. Right. Okay. And we'll talk more about that, and I'll put links in, the description below about your software. Cool. But, so then I guess from, after that, I think that you two went sort of separate ways because he was really focused on the technical analysis. And I think you, like me, whether for better or worse, right? We can talk about trading intuition later, like the concreteness of systematic trading. Right. I mean, through his position at thestreet.com, Gary was able to start a subscription service called Chartman, I think it was. Basically sell trading signals that way. And he took pride in his ability to look at a chart and, look at several charts and say, this one's better than that one. And I never
got any sense that that there was anything there for me. To me, the distinction between two similar looking charts was completely arbitrary. And when I tried to parameterize the differences and backtest them, that validated it. That at least for me. I mean, maybe there's subtle nuances that somehow add edge, but I seriously doubt it. So yeah, I mean, we stayed in touch, and I don't know if he still is today, but he kept using RealTest for years for some of his own stuff, and I started first 100% mechanical trading at the start of 2000. I was kind of moving towards it in 99, but I kept doing discretionary interventions and discovering that they made things worse. And
sure. So essentially, you added, algorithmic, order execution. Is that essentially what you mean?
No, I mean that I removed all the discretion in deciding what stocks to buy or where to exit. I didn't allow myself to intervene in that. I did have order automation starting in 2000, but I mean, in the sense that we were using a small so-called agency broker in New Jersey at the time. And, when we first started, we would actually call them every morning with our orders on the phone. And then we figured out we could email it to them. So my automation was actually to calculate what I want to buy and or sell and what sizes, and then automatically generate an email and automatically send it to them. And that happened before the open every market day. Later, after a couple of years of that, they, especially in 2005, when I started generating orders throughout the day, not just before the open, they gave me an interface. Like, they had a fix interface, but I didn't have software to deal with that. I didn't want to learn the whole fix protocols, but they gave me a little Windows app that could connect to their fix interface, and I could drive that Windows app from my automation, which was implemented in Excel at the time, Excel and VBA. So that all worked. And then I think 2013, maybe I changed to interactive brokers and redid everything using their API.
So you had 2013 you had 14 years of consistent profitability. Then you had 3 years where you almost moved in the towel or threw in the towel. And then you had 4 years that roughly, some of the best years ever. So, kind of take me through that journey, of, how you, that 14 years consistent profitability. Is that you were using the system that you're talking about now?
I was that was the whole time from 2000 through 2013. I was just running two strategies, one long and one short. I mean, I had many different versions of those two strategies in terms of changing parameters and changing the rules slightly, but it was basically the same thing that I had implemented with Gary back in 98, and then mechanized in my own way. They worked great until they didn't. I mean, it wasn't just throughout that time between 2000 and 2013. There were a couple of different times when they seemed to stop working, and I made changes, particularly in early 2005. Basically when I hit a drawdown that was worse than I had before or expected, I would retest and try to find new ideas. And it's not necessarily the best practice, but I think it's pretty much what everyone does. You have a bad drawdown and you tweak your system to get rid of that drawdown, and then you resume and hope that was somehow meaningful. So it's one of those things you hold your nose and do, even though it's probably bogus. So yeah, I did that a few times in that period. And the biggest change I made was since I was the main point of my strategy was to look for a breakout from consolidation with unusual volume.
Now this is before you were in Stockbee, correct?
Correct. I joined Stockbee when my trading started to go back. I mean, in 2013, when it seemed like it wasn't working anymore, especially the short side. When I first started in 2000, clearly that was a good year to have a short strategy, and I made all my profit that year from the short side, and it was like
Although some of the people here might not be old enough to remember what happened there. That's
it's true.
The dot-com boom and bust, I should say.
Right, but and that's kind of got implanted in my psyche as okay. I need to always trade the short side, and it's when you had good initial success with anything, it's hard to let it go. And 2012, 2013 is when the I don't know, everybody realized just buy the dip.
Mm-hmm.
That funny YouTube video.
BTFD if we want to. Yeah, right.
And and so the shorts, the strategy of what I had found previously worked well is the bigger the breakdown. You have a stock that's been going up and then suddenly it has a huge breakdown. Usually it was like a negative earnings morning or something like that. And you could just short it after that big breakdown and it would keep dropping for days. That would practically always work. But in late 2012, the regime shifted where that became a buy signal. And it took me a whole year to admit that change had happened and a pretty big drawdown. And that's when I finally said, okay, I'll do the opposite. And I got into mean reversion trading. But I mix things up now. I run some multi-day mean reversion, some one-day mean reversion, some short-term breakout and breakdown. In fact, I've just now reintroduced a new version of my old strategies, which I hadn't traded since 2015. Because with the rising interest rates, it seems like we might be back in more like that older regime again. So. Sure.
So I get so roughly how many strategies are you trading?
Right now, I'm running 8. There's 4 mean reversion and 4. I'm going to say trend following, but it's not trend following like a futures trader would use it. It's still a 1 to 5 day swing. I like that 1 to 5 day time frame. I just haven't found things that have the return versus drawdown ratio in longer time frames.
Right. Okay. Like. And then, I guess briefly, why would you want to trade eight strategies consecutively?
Because they do different things at different times. I mean, you look for them being not correlated with each other. I mean, it's just an extension of what I was doing from the beginning by trading 2 instead of 1, and specifically long and short. I want it to be market neutral, and then I thought of it in adding another dimension besides side is sort of style or factor. And professional hedge fund managers understand this much better than I do. But you're always looking for different factors and multi-factor models and that sort of thing. So I do my own little amateur version of that.
Have you ever seen the Ray Dalio Holy Grail video where he shows the returns of different strategies that are uncorrelated by any chance?
I don't think I've seen that one. I'll have to look for. I mean, I've certainly seen a bunch of his stuff and read his books, but I'm not familiar with that video off the top of my head.
Okay, so so basically, in essence, it just shows how powerful combining multiple strategies can be, right? Well, right. I should say multiple uncorrelated strategies, and that's essentially what you're doing. And again, what your RealTest is really good at.
Yeah, and they just have to be a little bit uncorrelated. You're not going to find perfectly negatively correlated or.
Yeah. It's funny because I learned that in the COVID crash, right? One of the things that obviously when, stocks go down, you expect, bonds, historically go up, but that's not necessarily the case whenever, the liquidity dries up, everything just falls, right? So, right. You have to really think careful about, is this really, negatively correlated or is it depending upon the market regime? I mean, I guess the only way to really be negatively correlated would have been at the short, but you get the idea.
But I first discovered that phenomenon you're talking about in, I think it was August of 2007, that there was an event that's known as the Quant Crunch, I think. And I noticed all of a sudden both my longs and my shorts were losing money at the same time. And that was very confusing. And I didn't understand it until like a year later when people wrote papers about what the mechanics were. Basically, it was a liquidity event.
Yeah. That's definitely something that I learned too. I mean, I still did all right, but could have done a lot better. Next question would be, how is your trading since that 2013 you joined Stockbee, you started doing mean reversion? Can you tell us a little bit about how you your evolution from there and the different trading systems? Maybe give us one, historically, nothing that you're using active, that maybe the audience could get a better understanding of what you're doing in today.
Yeah, well, so when my results started to go south in 2013, I was kind of looking far and wide for new ideas and so on, and I somehow stumbled on Stockbee on an internet search and noticed that they seemed to be also trading, swing systems based on O'Neill's work. So I thought, oh, here's somebody who's doing what I do, and maybe it's still working for them. So that I joined the community on that basis. But it's pretty much a discretionary approach to that. And over time you realize it's mostly about knowing what stocks are in play on any given day and having good situational awareness and all the stuff that good discretionary traders do. And so strangely, even though nobody on Stockbee was doing mean reversion, somebody mentioned it to me on there, and which I wasn't even familiar with the concept really, and so I started looking into it. Found the books by Larry Connors that describe his approach. The basic idea with the mean reversion strategies is you're looking for, like, if you want to buy a stock that's been going down for a few days, and then you buy it by placing a limit order if it goes down even more tomorrow. So you're looking to basically catch a falling knife at a reversal point. And you have to, keep your sizes smaller when doing that. When I first became aware of the strategy concept and started testing it, the results are so much better in backtesting than anything you can find with breakouts. So it really surprised me. I've always been pretty cautious and conservative in terms of adding new approaches or changing what I do. So the first year, 2014, I used half my account for my existing system and half for mean reversion. And the mean reversion, and I always insisted on having a long short pair. So from the beginning, I also had a short mean reversion strategy. The mean reversion pair, in its own terms, had a plus 40% year. So in my account terms was plus 20, and what I call my classic strategies made zero. And then in 2015, I said, okay, I'm just going to trade the two mean reversion strategies. They obviously are brilliant. So basically doubled my position sizes in those. And the year started amazingly. But then there was some very serious volatility in the market in the summer of 2015 and continuing basically from around mid 2015 into the start of 2016. And the long side in particular just got destroyed. And I had already discovered with the mean reversion strategies, they have a nice characteristic. When they have a drawdown, they tend to bounce back really quickly. And so I had back tested them with, not reducing your size when you get into a drawdown, because then it bounces back faster. So that seemed like a good idea. So I was trying that in late 2015 during that extreme volatility, and kind of got my head handed to me as a result. So I learned the hard way about keeping your size really small with mean reversion. The other thing, because with my breakout systems, I had always used the position size method that Gary had preferred, which is to trade literally the same number of shares on every position, whether the price was 10 or 80 or 50 or whatever. We didn't go up to, back then there weren't very many stocks that were over 100. It seemed much more the case. Before 1999, almost all the stocks lived in that kind of 20 to 80 range. And it actually is a reasonable method because the ones towards the lower end of that range have more volatility on a percentage basis. So you end up sort of volatility adjusting yourself if you just trade fixed shares, because you trade, smaller dollar positions at the lower end of the price range. And back then that worked. Now I would not recommend it. But I applied that same, I figured let's develop mean reversion strategies with that same sizing technique. But that was not a good idea. Because I ended up having some positions that were like maybe up to 20% of my account in one position, and then trying to catch a falling knife at that size, so that wasn't so good. So yeah, I adjusted to that.
Okay. Now I know you said that you had some of the strategies essentially had challenges during various periods. Do you do any like regime filtering or anything like that, or are your strategies always on?
They are. They're still always on. I've experimented with regime filters. I do use, long-term trend filters for the individual stock in some of them, not in all of them. But every time I try to backtest a general-purpose regime filter, I find it hurts the results. Now, that's partly because if you take a system that you've already optimized and then apply any kind of filter to it, it'll probably make it worse. You almost have to start with the idea of using a filter if you want to use a filter. But anyway, that's what I do.
No, that makes sense. Yeah. So, for instance, you mentioned the trend there. So, your long mean reversion, I'd assume there's probably some type of trend in there. You want to buy stocks that have been going up and then had a short down period. Would that be a correct assumption?
Yeah. Right. Yeah. You usually it's good to just have a long term, like above the 200-day moving average, let's say, and that gets you to not trade this strategy during an extreme market meltdown like 2008, hardly any stocks are above their 200-day moving average, so you just end up not getting any entry signals. So it kind of acts as a regime filter on its own. But the thing with a shorter holding period, regime filters at the market level is less relevant because there's always individual stocks moving in both directions on a shorter time frame. So you just end up leaving too much on the table with a regime filter at the market level. For a longer term strategy like a monthly rotational NASDAQ momentum system or something, you definitely want it in there.
Okay. No, that's interesting. Okay. Perfect. And then I guess, what is, from there, what does your trading look like today? Maybe some of the, what have you learned? Like maybe some of your key points that have you learned, over your time period trading?
The main directions I've evolved besides what I was just talking about in terms of how to size positions. And now I always just use a simple fractional sizing. Right now I'm using 5% of my account as my position size on every trade. And as I add more strategies, I'll reduce it. I was using 10% when I only had 4 strategies, and now I'm using 5, partly because sometimes 2 strategies trade the same symbol. So I want to keep the same stock exposure lower. More conservative sizing, diversification with more strategies, and simplification of the strategies. I used to add too many rules, try too many parameter values, and I just keep simplifying them more as I go along. I'm just trying to. I'm more focused on just wanting to. There's a certain factor you want to capture. So short-term mean reversion, short-term breakout, whatever. And I've also started the what's allowed me to, because I had there's basically a 2x2 matrix, right? You have long versus short on one axis, and you have momentum versus mean reversion on the other. And so I kind of had that covered with my 4 strategies for a few years there, like 2016 through 2018 or so. And then I thought, okay, well, how can I add to this? And I thought different subsets of the universe. So this was another idea I got from not only from Stockbee, but from someone who you've featured in some of your videos, who goes on Twitter by Scotland. He was very focused on trading IPOs in Stockbee. This was, I think, before he got really active on Twitter. He was in Stockbee sharing these ideas. So I came up with a system for that, for trading recent IPOs on when they break out to a new all-time high, and that did really well for me from like 2017 through the middle of 2021. Hasn't done anything since then because there haven't been very many, but and that one kind of has its own built-in regime filter because there aren't any IPOs when the market's going down.
Right. No, that's interesting. Yeah, that's true. Once they raise capital, unless the market's frothy, right? They want to get there as much as they can. And then you can also, I use the Norgate data, which has all the historical index constituency available. And so you can experiment with different sub-universes that way, anything from stocks in a specific index like Russell 2000 only, or to stocks that aren't in any index. It's another interesting one to look at. Mostly you get ADRs when you do that. But okay, right.
But yeah.
And that's the data provider that you use for your backtesting, Norgate?
Mm-hmm.
Yeah, no, they're pretty good. I actually did an analysis of some of the various providers, and Norgate, was one of the better ones. Yeah,
they're very good. It's all they do, and because what you really want when you buy data is also metadata. Especially if your trading involves starts with saying, I want to scan the whole stock market every day with like a liquidity filter to find the best setups. You need someone to maintain that definition of the whole stock market. What is that? What are all the symbols for U.S. common stocks, and so on, and be able to know something about each one. At least like it's what exchange it trades on, what index it's in, that sort of thing. And it's way too much work to maintain all that yourself from free online sources. It's worth paying for data for sure.
Yeah, then the survivorship bias, and what makes your longs all look better, right? Because nothing is in the index anymore that fell out. So yeah,
right.
having the good data.
There's two sides to survivorship bias, which one is to, especially for longer term strategies, you want to make sure your data includes things that died, like Enron and WorldCom, but also conversely, like if you start with a universe of everything that's ever been in the Russell 3000 and you just trade that, you get look ahead bias because you're trading things in the past that are going to be added to the Russell 3000 later,
right?
Because they grew enough to do so. So that's why the historical constituency is so important.
Right. No, absolutely. Perfect. Okay. So then, today, how's trading going today, for you, Marsten?
You mean this literal day, or you mean recently?
Oh, just in general. Yeah. Yeah. This very day, right now. No.
I think I'm actually having an up day today because I generally do better when the market's going down. I've never done well during the periods that tend to be the favorite for the discretionary crowd when everything's just going straight up. Though I had my best 12-month period ever, making 110% between July 2020 and July 2021. Not a calendar year, but that I consider a mediocre result because, I know of people who made over 1,000% during that period. That was like the easiest time to trade since 1999. So, okay, I caught a little bit of it. Since July 2021, I've actually been in a drawdown. It's the longest drawdown I've ever had. It hasn't been the deepest, but and I almost got back to peak equity. I don't remember exactly when. It was sometime in early 22, maybe. I don't know. But so yeah, I think it's been a trickier environment for sure since July 2021, and I know a lot of other people who have found that as well. That it's just harder to trade right now.
Yeah. And I guess you feel like trading's getting more difficult over time.
Yeah, I mean, it seems whatever you're doing seems to kind of to stop working at some point, but sometimes things start working again. But yeah, it probably is. I mean, hard to say. It's very hard to sort out random fluctuations in your results versus some deeper change.
Yeah, it's interesting because, some traders will say, the market's moved the same way, since, since that's been documented. And I think there's a hint of truth to that, but at the same time, everyone's also competing to trying to find all of these edges. So, I was just curious on your thoughts there.
Yeah. I mean, and if you get back far enough, a bird's eye view, you can see, everything looks the same, or that's analogous to when people say, the same patterns occur on every time frame. Yeah, maybe if you don't look at the details too closely. But, in the end, you need to have an entry rule and an exit rule and not get whipsawed too often. And that's what it comes down to. I mean, like trend following is a great example. It's a classic strategy that everybody knows. And it all comes down to whether you make enough on the outliers to make up for all the chop that you pay. And that comes down to the details of the strategy.
Yeah, I was looking at some of the trend following, equity charts, and I don't know if I'd have the mental fortitude to be able to withstand some of the drawdowns that they.
Right. Well, one trick they use is to redefine drawdown to be only based on closed positions. Because if take in stocks, take it as an example, Tesla, if you bought it in mid 2020 and you've had a huge drawdown, but you're probably still up substantially.
Yeah, no, that's a good point. So it's actually could be even crazier than they're telling us too. So
right.
Okay, and then I guess one post that you made in Stockbee that I thought was interesting. You said that as someone who's traded mechanically for 21 years, which you're adding to that too, and one of the only mechanical, I think the only mechanical trader featured in Market Wizards. You said that you'll not make a killing, using a systematic approach. Your average return is around 20%, which is still, fantastic when you put it up with, New York professionals. And you spent thousands of hours backtesting, and you still feel that the systematic side, or systematic traders are at maybe a disadvantage compared to discretionary traders?
It depends what you're looking for. I mean, it's really hard to know. I mean, certainly, Market Wizards will highlight certain discretionary traders who have had long-term. I mean, one thing Jack is always looking for is long-term consistency. And that's really the only thing that got me into that book is the very long-term results that I have. And that's certainly an advantage of systematic, I think, is that you can do it longer. I think the day-to-day, especially a short-term discretionary trader, it must wear you out after a while to be having to watch the screen all day. In both cases, I think on the discretionary side, it's more true that the people we hear of are extreme outliers. There's a lot of people who try to trade and just blow out an account and then don't do it anymore. So yeah, I mean, if you have 1 million people who try to do something, you're going to have 0.1% who have extreme success, and then it's a kind of survivorship bias. And I think that's less true with mechanical trading or systematic trading. I mean, there's not some magic edge that people find. I mean, the outlier there is, of course, Renaissance technology, and nobody knows exactly what they do. But from the recent excellent book about them, can't remember the title of it, but
The man who solved the market, is that what it was? Is that the one you're referring to? Okay.
That although what he really brought to the table was bringing together a bunch of brilliant people and managing them really well. Just getting all the details right in your infrastructure, getting your executions right. There's a lot of details to work out.
Yeah, so there's less room for error. Yeah, it's funny because I don't really know if I have a choice of being discretionary or or systematic. I feel like it almost chooses you, right? So I've got a tech background and I love programming, maybe just as much as trading. I don't think I can stare at a screen and trade for long periods of time.
And another factor is what kind of decision maker you are. I don't like to make decisions in general. I don't like to make quick decisions in particular. I like to get into the weeds and make sure I fully understand it, and I go way too far in that direction. If that's your personality, you're not going to. It's going to be harder because good discretionary trading is making lots of decisions and effectively and often quickly.
Using, intuition, which, after how many hours of staring at a screen, right? And I'm sure it's there, but again,
I doubt there's any successful discretionary traders who just are purely intuitive or purely situationally aware. Maybe some are. Maybe the pit traders were like that, but they were all very short term. They were really market makers, so that's a different game.
So if you had to say what's the superior trader, I guess that's a really silly question, but so you feel like that both systematic and discretionary obviously have their advantages and their disadvantages, right?
As with every other choice in trading, it comes down to finding what works for you. Like the best system is the one you can actually do. The best approach is the one you can actually do.
Yeah, it's funny that you mentioned that because, as I was saying earlier, I started from the valuation perspective, and while I did pretty well at it, it just over time, I didn't like the drawdowns. I wanted a faster pace, and I like the maybe not. I don't want to call it the game, but it kind of is a game, but more of the challenge of trading, more than this valuation where you value something and then hopefully in 2 to 3 years you're right.
Right. Yeah, it's just not enough at bats. That's what I couldn't tolerate about the idea of long-term investing either. Like, how do you become statistically significant?
Yep. So I guess that's a great question. So when you're looking at your back tests, what are you looking at to determine statistical significance? How do you, take a new idea and then, run that through to something that maybe you're confident to trade with? I don't have a system development system. That's where I'm pretty intuitive when it comes to when I decide a system looks good enough. But I want to see a back test with, let's say, 1,000 trades in it, certainly at least 500, maybe more. And I'm generally looking I don't look at a whole lot of different stats. I look at the return and then not just the maximum drawdown, but I have a calculation of maximum adverse excursion, which is sort of like, imagine you were running a system and watching your net liquidation value in your IB account all day, every day. What's the worst number you would have seen? That's what MAE is good for. And that's kind of a good, psychological thing because I know from experience, like, when that number gets too bad, it's hard to take. So I'm looking for. My usual threshold is I want to see the annual return be equal to or greater than the max drawdown, and ideally the MAE. So kind of a 1.0 MAR ratio, as people might say. And then there's some kind of qualitative aspects. Like, I want to make sure I understand something about the system. It doesn't have to be like a whole narrative, but
I'll go through a lot of the trades in the back test and just get a feel for the dynamics. Or like I'll sort by biggest winners, and then I'll sort by biggest losers and understand what's going on there. Maybe I'll get an idea for another filter to add, but I don't go too far in that direction. Because in the end, backtesting is taking the set of all possible trades that anyone could have made in the market and filtering them down to a profitable subset. And we all know the issue with that because they all happened in the past.
Yeah, exactly. And so when you're developing your strategies, you're, theory driven versus, data mining empirical. We're kind of reversing out that, right? So
yeah, I did some experimenting with, rudimentary data mining a decade or two ago, and I don't know, it just didn't resonate with me. I mean, you're trying to forecast what's going to work in the future. And certainly, I think you can pretty much rule out anything that has never worked in the past. I mean, I can't think of any reason to trade a strategy that has never worked in the past. Probably want it to work more often than not. If it had a big drawdown, I want to understand why. I mean, I trade mean reversion shorts, which got absolutely killed in 2021 with the meme stocks. In fact, I have an example strategy in my software, which I put in there before that period, and it had. I mean, its equity curve looked like Bernie Madoff, but then it had an 80% drawdown in January 2021 because it bought GME. I mean, but before that there was never any stock in the database that had that kind of a gain. Because nobody had discovered options gamma squeeze yet, I guess. So you never know what might happen. Yeah, somehow. I mean, that's still like that could have happened to me somehow just by random luck. The particular version I was running didn't trade it, and I've since taken I do some things in my execution software now that I don't backtest. I just consider them as like risk management. And one of them is, it occurred to me during the meme stock squeeze that, IB has changes the margin requirements for individual stocks on, every day, or actually multiple times a day. So just set a cap. I figure if IB says they need 100% margin for this thing, maybe I just won't short it. So that saved me from some of the bigger losers. I put that in as soon as I saw that thing starting to happen.
Okay, so perfect. I think we're getting pretty close to an hour here. Kind of wanted to talk about, is there any books or podcasts or anything like that, or any piece of advice that you would like to share with traders, new systematic traders, or even discretionary traders for that matter, of how to, get started and maybe have half the great track record that you do?
I mean, the main advice I would have for anybody is to get your hands dirty and do your own experimenting. You've got to get, even if you're just discretionary, you've got to do some sort of back testing. And if you're going to do sort of visual manual back testing on charts, like a lot of discretionary traders do, be careful because confirmation bias is way too easy. Like if you're looking for nice looking breakout setups like they do on Stockbee and just looking for all the winners, you're not checking. You really need to say, okay, this setup happened. It's harder to spot the ones where the setup happened and then failed, because it just looks like noise on the chart. So that's where backtesting can be very helpful. But the key advice is to set up an infrastructure that lets you do your own experimenting. Just constantly iterating with, well, what if I try this? How would that have done? What if I try that? How would that have done? And so on. There are. I can't point to a specific book that tells you exactly how to do it. You really have to try. I mean, the best thing is to join a community and of other people who are doing the same thing. And I'm happy to now have built a really nice community in the RealTest user forum, which I keep closed, except to people who actually use the software. And that creates an environment where people are comfortable sharing ideas and discussing what they're trying. And so that, I mean, podcasts, I listen to all the usual. I certainly listen to all the ones I've ever been on, and some others. Even though I'm not into trend following, I really like the Top Traders Unplugged series that Niels Kastrup Larsen has.
I listen to that one too. Yeah.
Yeah, and I used to listen to all the Andrew Swanscott Better System Trader ones, although he doesn't need to do them anymore. The Chat with Traders, I listened to most of them, although most of that had more of a discretionary skew. But it's going in a new direction now. That's interesting. I was delighted this last one they had Patrick Boyle on, who's a different sort of guy. I love his podcast series called On Finance, where he talks about there's a lot of market history in there and so on. And I had no idea about his background until I listened to his recent Chat with Traders episode. And he has quite a trading background. He used to work for Victor Niederhofer, and he discovered early on that he was a systematic trader himself, and started corresponding with Victor and got offered a job.
Okay, that's great. So that's great. Cool. Perfect. Okay. And then, can you share us a little bit more about RealTest for those that might be interested in, using your software? Yeah.
I mean, I have a little rudimentary website called mhptrading.com, and you can read about it there and download it and try it. It's backtesting software. You have to import data. I recommend Norgate, but you can also use Yahoo to get started with some free data, or your own CSV files if you have them, or Metastock data if you have it. It comes with a lot of example strategies and scripts that help you get started, and it requires a little bit of scripting. But I've had quite a few people who have tried to learn other backtesting software that requires more like a programming language, and couldn't get anywhere. And RealTest evolved is sort of like, it's more like filling out a form. In the older versions, you would put in your entry setup formula, which is it's more like a scan criteria that you would write. And so that's still how it works, except rather than filling out a form, you type the label on the script. Like you'll type entry setup, and then you'll put in your entry setup formula, and you'll type exit rule, and you put in an exit rule formula, and so on. And these formulas are grouped into named strategies, so you can put as many strategies as you want and run the test, and you get the stats for all of them combined, and you can see all the equity curves separately as well as the combined curve, and so on. So the goal is my goal with it is to make a tool that's really easy to interact with and really fast, so you can kind of get into that real-time experimentation loop that I was talking about earlier, because that's how you learn it.
So I did sign up for the beta a long time ago to check it out. And I felt that it was actually very easy to use because, right, when I use Python for my trading strategies, and you don't have to necessarily know a programming language. You just have your essentially scripts, which, if I recall correctly, they're very simple. So for those that might not want a programming language like Python or Rust or C or whatever, that just want something that's powerful, I think you should probably check out Marsten's RealTest.
Well, thanks for the plug. Yeah, as a sort of indicator of that, my 8 strategies that I'm running right now, the entire script, which they're all in, including all the indicator calculations that they use in the part that says how to import the data and all the settings and everything, is under 200 lines long.
Yeah, that's phenomenal, and it's quick, right? I know that unfortunately Python's easy to program in, but I'm actually with some of my strategies, I'll run it and then go have dinner and then have to come back down later, and I'm like, oh, this is starting to be a little bit unwieldy. But
yeah, right. I mean, a simple strategy, like if you wanted to test a classic NASDAQ 100 rotational strategy going back to 1990. Using historical index constituents. I mean, it takes, 2 or 3 seconds to run that back test. RealTest is when I was working as a software engineer, I was primarily a Windows C programmer using the original Windows API, just like Microsoft used to build their original Office suite and so on. And for better or for worse, RealTest is still written in that language, which makes it harder and harder to find anyone else who could ever maintain it. But it's small, fast. It's completely built on the original Windows API. Requires Windows. I mean, the good news is a lot of people run it on a Mac using whatever they call those things, Parallels or But yeah, you do have to have a Windows installation for it.
Okay, perfect. So then if you're interested in, algorithmic trading and multi-strategy, something easier than a programming language, check it out. So Marsten, I really appreciate your time today. As I mentioned earlier, essentially one of my trading heroes. Pretty cool to have you as the first podcast guest. Very exciting. Cause quite frankly, there's, really not, that many systematic traders out there, especially, that are market wizards. So I'd like to thank you once again and, like to stay in touch.
Thank you so much. I'm sure we will. Yeah, good luck with this series. I'm sure you'll do well with it. And it's been really great to meet you.
Perfect. All right. Thanks, Marsten. Take care.
Yeah. Bye.
You've just listened to the first ever AlphaCast episode. If you like this conversation with Marsten Parker, the legendary systematic trader, please give it a 5-star rating or thumbs up, depending upon what platform you're on, so that way other traders and investors can be lucky enough to listen to this fantastic guest too. Thank you.